All right, so we're getting a flurry of tariff proposals from the president. We had Howard Lutnick on our air yesterday, also talking about potential progress when it comes to moves with the EU. What does this all mean for the market and also for the Fed? Does it change the math at all when it comes to your thesis, when it comes to the market?
So it doesn't change our math at all as it relates to Fed policy and the path forward for rate cuts. We're still believing, as the Fed continues to push, that there's dovish forward guidance and a more accommodative stance to come. So we do believe eventually we're going to get more rate cuts, but the data doesn't suggest that the Fed needs to do anything at this point, which I think aligns very much with our view. The key for the market is not so much Fed rate cuts. It's much more about getting clarity out of what I continue to describe as the purple haze of fiscal policy uncertainty. As you said it, the purple haze is fully back in effect this week with a lot of the tariff headlines that are being announced.
All right, right now, futures, they're kind of a bit muted, but we have to remember the markets are sitting very close to all-time highs when we're talking about the S&P at the NASDAQ. But you're also looking at the bond market, the long bond, the 30-year, pretty close to a 15-year high. We also, I just mentioned it, the dollar coming off its worst first half of the year in about 50 years. How should equity investors view that action when it comes to bonds and currency?
I think it's a really helpful and important signal for all investors. I've been sort of describing it as the bond market is the adult in the room, saying, Houston, we have a problem as it relates to deficits and debt levels. Of course, we have this big package that's come through here, but the key question is, how are we going to pay for it? And so all the action in the yield curve has really been with the 30-year, the long bond, as you said, with that pushing higher, with the dollar index making new lows here. It doesn't give a lot of room for the market to move forward. It's really the bond market saying, we're not going to give you a lot of policy room here. It's more of a bearish kind of a view. So we are seeing a steepening in the yield curve that tends to be historically positive as a leading indicator for growth. But I think this time around, given some of the dynamics, some of the guardrails that are in play here, it's actually foretelling a more bearish story, has much more important implications for deficits and debt levels than really telling us anything about long-term growth.
All right, even with the markets at all-time highs, people want to put money to work. I want to get your take on the cyclical sectors that have seen pretty strong performance from Q2 up until now. With your thought that we might only see one rate cut and potentially tariffs, maybe even changing that math. We see, potentially 200% tariffs coming down the line, tariffs on chips, potentially tariffs on copper. Does that change your view on cyclicals? I was talking to another chief investment officer. They said right now might be the time to take profits on industrials that have been a leading sector and also fade the rally on small caps that we've seen over recent weeks.
We've been riding this wave of using both the correction and the rally to reposition portfolios. So we're not taking the view that the market is overly frothy here or that we're in a place where we do need to be de-risking or building cash positions. So I would be using a second quarter earnings season and the results that we think are likely to come in much better than expected to reposition portfolios. You called it out. I'll reiterate it. Quality-oriented cyclicals, not the deep value stories in this environment, we do think continue to be very well positioned. So financials, industrials, I think are going to show much better than expected results. Perennial tech continues to be a leader. We think that'll be a positive story as well.